Hey everyone, Patrick Jackson with Mann Mortgage here with this week's market update. Today is Thursday, September 22nd, and it is about 11:20 on the West Coast. Last week on Tuesday, we got the really bad inflation data that drove rates up throughout the week. Going into yesterday's Fed rate hike meeting, the average conventional 30-year mortgage rate was about 6.4. I wish it was 6.42%. And then yesterday, like I said, let me bring that up here. We got the announcement of the newest Fed rate hike to their federal Fed fund rate, which was expected to be at 75 bips, and what it did come in at 75 bips. So we all knew that was going to happen. What we were waiting for in the markets and in the bond market and the people that watch this stuff for mortgage rates, we were waiting to hear what Fed Chair Powell said at his press conference after the Fed rate hike, and what data the Fed released along with with their news. It's kind of like Groundhog Day. When the groundhog shows its shadow, we get winter, spring, whatever. Based on what Fed Chair Powell says and their comments, we kind of get an indication of what they kind of expect in the future. So the short version of how the markets reacted to that was they hated it. They hated what he had to say. They hated the data. So like I said, they did hike at 75 bips. We expected that. The inflation remains elevated. They're not considering selling any of the mortgage bond securities that they currently own, which is a good thing. But a small sliver of sunlight in amongst a bunch of darkness. The Fed funds rate, they expect it to go up to 4.4% by 2022. So if we're at 3.0, 3.25 right now, they're expecting another probably two hikes coming up before the end of the year, equaling about 1.25%, whereas they had predicted before about 3.4% capping out at. So we didn't like hearing that. And what we didn't like even more so was in 2023, they show that going up to 4.6%. So they basically are not predicting any sort of Fed fund rate cut in 2023, which the markets and the bond markets and people that watch this stuff were kind of expecting. Once inflation's under control, you can cut the rates, and that would do a rally, and that would help out not only credit card rates, which is stuff that's directly applied to, but the trickle down effect of mortgage rates, and would help our rates. So if you look at the numbers, inflation, their target was 2%. Now it's 4.5% in 2022. So well off there. And then 3.1% in 2023. So still 1.1% above their target. Unemployment rate, we're at 3.7 now. They expect to go 3.8 by the end of the year and 4.4% next year. And then the GDP, our economy, they revised it down from a 1.7% growth to 0.2. And then next year they just show about 1.2% growth, which is really flat growth. So if you take that unemployment rate rising, GDP being negative, along with all the other recession indicators we've seen over this last 6 months or so, this is about as close as the Fed's going to come to saying basically we're going to be in recession. And so that all indications is that's where we're headed. And like I said, the markets did not react positively. The markets, like we liked the rate hike to begin with because that will get inflation under control. But now, like a lot of things the Fed does, we feel that they've overcooked things and they're going too far in the extreme, and they're going to stunt economic growth, and rates are going to spike. So it's kind of the Fed's always driving while looking in the rearview mirror. They're always making decisions based on data they have from previous months and not really looking at what's going on right now. And then even these Fed rate hikes take a second to take an effect. It's not like this is instantaneous and the economy is affected right away by what they did yesterday. So they don't factor that in. So they don't factor in that any movements they make are delayed. And then the other analogy that I heard that I feel is a good one is, imagine the economy is a baby and you're trying to draw a bath for it. You wouldn't turn the water all the way hot because that's going to burn the baby. If the water got too hot, you wouldn't then go all the way cold for a while because then the baby's going to freeze. You try to find like a nice happy medium. And the Fed seems to have a really hard time trying to find a happy medium and the way they deal with these rate hikes. It seems like we're at one extreme and the other. And that volatility is something that the bond market and mortgage rates do not like. And that's going to have, obviously a negative effect on people's buying power. So where does that leave us? We're, after that, after what happened yesterday, the average conventional jumped from that 6.42 to about 6.62% this morning across the country. So we're above 6.6%. That's obviously not a positive. Possible options going forward, which we might see. Let me get out of here. The two options that might cause them to pivot, one would be inflation gets under control faster than they expect. That's something we should, be looking forward to and hoping for. If inflation gets under control, then maybe they don't have to do as aggressive a hikes, or maybe they cut the Fed fund rate in 2023, and that would spur, a mortgage rate rally. The other thing that could cause them to change their mind would be if the economy is overly negatively affected. So if they see recession kicking in and the economy takes a dive, maybe that makes them back off and either cut rates or not do some of the rate hikes that they're planning on doing, it looks like. So that's not something to necessarily root for, because it sounds like we would be in some pain to begin with. But that would probably cause them to maybe pivot off this path that they're currently showing and go into something maybe a little bit, trying to coddle the economy a little bit more. So on a brighter note, we did get existing home sales yesterday for August, and those came in positive for a change, which was nice. The main thing to draw out of that report was that the inventory started to crest. So the inventory in July was about 1.31 million, and it dropped to about 1.28 million in the month of August, which we talked about. That happens every year. Inventory goes up throughout the summer when it's selling season, and then school gets back in and people take things off the market or have already been settled, and inventory comes down. So we don't have to worry about an inventory of a huge inventory glut like people were talking about. And if anything, if you subtract pending houses out of that number, it's even smaller. So if you count everything they're counting, we're about 3.2 months supply, where a healthy market's about 6. And if you take out pending and it's just things that are available to buy, basically, we're about 1.9 months, which is again a good number. Like I said, a small number, which shows we're still going to have a demand issue. So that's not necessarily good for home buyers looking right now, but it is good for supportive of pricing. So people that just bought or currently owned, the lack of inventory should keep their prices elevated, and they shouldn't see a big loss of equity and a big loss of value. So that's a positive. And then the other thing that came out was CoreLogic's single family home rental index showed that it's still at about 12.6% year over year. Like we've talked about before, if you're a renter, that's not good. Much better to be a homeowner, be in control of your payment. You get a fixed payment for 30 years. Even with elevated rates, you can't say that a landlord is going to give you the same rent for 30 years. So that's one way to look at it. So, really the people that should still be buying and aggressive about buying in this market, especially with, you're seeing sellers starting to make concessions now with prices coming down and seller credits and stuff, is people that can afford the payment, first of all, people that are renters, and then people that are looking, trying to make a life change. If they want to be, they need to move, be near a job, but they want to be near family. If they can afford the payment, if it makes financial sense, they should still do that. So if anybody has any questions about this, about the markets, please reach out, and please don't hesitate, and I'd be more than happy to help. If anything comes up in the market before, I'll give you guys a quick update, but otherwise I will see you guys next Thursday. Have a great day, guys. Thanks.